Now let's move on to 90% acquisition and consolidation, the process. Now the consideration for 90% acquisition is $117,000, and the P controlled S company by paying cash consideration. We have the same process, but we need to consider what? Right, non-controlling interest, the rest amount of this to control power, 10%. Okay, so we will use the same account here. 100%, no, it's no 100%. Investment now 90%. Investment in S company. Now the P company purchased this company by paying only 90%, which is $117,000. So actual pay amount of cash is 117. Now the consolidated procedure for the adjustment as if merger. Why? Because the P company has the majority of the control power by purchasing 90%, which is greater than the 50%. But the company also has a responsibility to present what is the portion of the rest amount of control power, which is 10%, as the non-controlling interest, the account in the equity section. Okay, so we use the same name of account from there. Now I'm going to collect everything, and the value also, I believe, are the same as previous exercise. Okay, but only the difference is what here. Now the investment in S company should be removed in the consolidation procedure. So $117,000 removed, and then this NCI, which is 10% of this control, should be calculated how? 117,000 divided by 90%, which is 100% control, times 10% is now 13,000. So the sum of this 90% investment, 117, and 13,000 is 130, which is the same as 100% at the consideration. Okay. Now let's calculate one more time the sum of this minus the book value. Sum of the book value of equity and the differences. As discussed in the previous exercise, here you go. The fair value of net asset is equal to fair value of equity, which is same as the book value of equity plus the differences. That's why we put this book value. Again, why do we need this procedure? Unlike the mergers cases, the consolidation process needs to remove this equity, because merger automatically extinguish the acquired companies the equity, but in the consolidation process the S company still exists. That's why we have to manually remove this book value of equity in the working sheet. Again, you have to keep it in mind that we do not remove the book value of the S company, book value of equity of S company in the balance sheet of this the S company. Why? Because S company still exists, still operating. Okay, so we are just adjusting by adding all this asset and liability, and we adjust only the differences. Okay, but we need to remove this book value of equity manually, because we are going to include all the assets and liability. Okay, but here non-controlling interest 10% should be presented on the equity side. There you go, on the equity side on the consolidated financial statement. Okay, So let's put all this debit and credit adjustment account. First, this cash out, 117,000, and then investment, 117,000, and then inventory starting from the inventory, only the difference amount. Then I put until the franchise, and then the goodwill is $12,000. Goodwill also kind of different, but it's unidentifiable, the difference. So we include everything, here we go, and then this investment in S, right? And then what else? Do we have any adjustment here? No, we just want to add this P company. The reason why we present S company here, S company is still existing, okay? And then we don't have any adjustment on the liability. And then finally, we want to remove this book value of S company manually. Okay, then finally, non-controlling interest, $13,000. Again, we want to present consolidated financial statement as if 100% merger. But the company, the P company, spent only 90% consideration. But the P company is enjoying this 100% the control to S company, subsidiary company. That's why the company should present what is non-controlling power, what is the minority interest except for this 90% control. That is the 10% of non-controlling interest. So that by including all this 100% asset, the fair value of net asset, that fair value part, 10% of fair value of asset is part of this non-controlling interest. Okay. Now let's combine the same way this manually S company and add the asset minus the cash out, asset out. So we have this, and then the total new asset amount on the consolidated financial statements is 496,000. So let me just make sure that if we got the right answer. So the sum of this two and plus, okay, it should be the same. One more time. Asset plus adjustment asset increased and decreased. Okay, we have the same result anyway. Okay, and then do we have any adjustment of liability? No, we don't have any adjustment, but we should add this S company to P company manually. So we got it. Then finally the capital now 100,000 and minus 50,000. Oh, sorry, plus 50,000 and minus the 50,000 manually removed, because now the reason why we have to remove this, the book value of this S company, is that the company acquires all the asset and liability, which is the fair value of net asset, including these differences. So you got it. I'm going to just plus this, and then let's drag down. So we have now total equity here. Let me just sum up this total equity. So 176 is the total equity as if merger cases or 100% consolidation, the acquisition cases on the P's consolidated financial statement. Okay, so let me just clarify this working sheet. then the sum of this liabilities and the equity, then this should be, you can just put liability and the equity, we have the same result. Okay, so the point of this the exercise is to identify what is the non-controlling interest, and then how much is non-controlling interest, where do we put this non-controlling interest, because this 90% of acquisition include the 100% of this asset and liability, then they spend only this 90% of consideration. That's why they have to include this 10% of non-controlling interest part on their equity section. Okay, so see you in the next video clip. Bye bye.